Hey traders, and welcome back to another video. When the market is in a strong trending phase, the majority of traders expect a pullback to occur, and when the pullback happens, they don't know that at which point should we enter into the market to earn huge profits. This is the phase where a lot of traders face losses. That's because a lot of traders enter at a random point during the pullback, and also, there are some of the traders who do not enter during the pullback as they fear from making losses. And this is what is the topic of our video. Now before we start the video, if you are interested in the topics like this, then do like this video, and be sure to subscribe to our channel along with clicking this bell icon so that you don't miss out any of our upcoming videos. Now let's move on into the video. Let's begin with the basics of the Fibonacci retracement levels. The Fibonacci retracement levels are given by Leonardo Fibonacci. So basically, what are Fibonacci retracement levels and how are they useful in trading? The Fibonacci levels indicate where the support or resistance would occur. These retracement levels are in the form of horizontal lines. Leonardo Fibonacci gave two concepts which is useful in trading. The first concept, which we all know, is Fibonacci retracement, and the second one is the Fibonacci extension. The Fibonacci retracement helps us with knowing where to enter along with determining the stop-loss levels, as well as the target levels too. The Fibonacci retracement levels are highly useful at the time of pullback. Now let's learn what does a pullback mean before we move on into the video. So, basically a pullback is short-term decline in the trending phase of the market. This short-term decline of the price is for the temporary time period only. It is usually formed when a lot of traders start doing their profit booking. The goal of each and every trader is to enter during the end of the pullback in order to get sniper entry into the market, which helps them in maximizing their profits. Now this is where the Fibonacci retracement levels help us. Basically, there are 5 levels of the Fibonacci retracement. These levels are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Let us learn how to draw the Fibonacci retracement tool on the chart through an example. So here we have a chart of the Euro-US dollar currency pair. The price is making higher highs and higher lows. This indicates of market being in an uptrend phase. And as the market is in an uptrend, we will look out for the areas from which we can go long. Now, for getting bigger profits from the market in a situation like this, we need to wait for the price to make a short-term decline, or you can say pullback. The price has made a lot of pullbacks earlier, but the candles that were formed at that time were of smaller bodied candles, which clearly indicates that the sellers are not too strong to break the price to downside, and hence, these candles have acted as an indecisive candle, and that's why there is no assurance of the market going above from this level. And therefore, it's not a good point to enter. After making smaller setbacks like this, the market has finally made a bigger pullback. But you should not enter into hurry when a pullback like this is formed. That's because it's not confirmed that this is a pullback, as this could turn out to be a reversal too. Now here is where we would draw the Fibonacci retracement tool from. We would grab the Fibonacci tool from this swing low till this swing high. Now this is the point where a lot of people get confused. They pick any random of the swing low from these ones, and then, when the market does not respect any of these levels of the Fibonacci retracement, they consider this tool improper, and hence they avoid using it. But the truth is that if you choose the correct swing low, then the market would surely respect at least any one of these levels of the Fibonacci. So, there's a trick to find the correct swing low. Let's learn through this example only. So the price had made a swing low here, which made a bigger swing high as it broke the previous swing high to upside. And after that the market started making new higher lows and higher highs. Now here is the catch. If the price would have made a swing low below this one, and that swing low would have broken the previous swing high to the upside, then we would have considered this low as the swing low. But it's not like in this case, and hence we would draw the Fibonacci tool from this swing low. This trick is recommended for medium-term and long-term investors. Now, if you are a short-term trader, then you can pick any of this swing low among all these, The opposite of this is what happens in the swing high scenario. In this example, we have this high, which is highest amongst the all. Now you must ensure to plot the Fibonacci tool up till this swing high. You can take any of these swing lows from which you can plot the Fibonacci tool, but you will surely have to plot them till this higher high only and not till this previous one's highs. You have to consider this trick when you plot the Fibonacci levels from low to high. And in the case of plotting from high to low, you can pick any of the swing highs that you want based on your trading style, but you must plot it till the lowest swing low to get better results from it. Now let's get back to this example. So the market has already gone below these two levels, and thus we are now only left with these three levels. The market went below this 50% level also, which leaves us with the option of only these two levels. The price has now reached at the 61.8% level. Let's see how the market reacts at this level. The market has started making smaller body candles with bigger wicks. This shows a sign of weakness among the sellers, and thus the market can make a reversal from this point too. Let's wait and see what the market does. The market has started making green candles with bigger bodies and smaller wicks, which is why we can conclude that this is a good point to enter. Let's take entry from this point. The stop loss will be placed below this 78.6% level, and the targets will be kept at 3:1 risk-to-reward ratio. The market started going above from this point, which helped us in making significant profits from the market. Keeping the stop loss below this 78.6% level helped us from the stop loss hunt. That's because the market went a little below this 61.8% level, which removed the early buyers, and then it took a U-turn and moved to upside. The proper placement of stop-loss levels is a must. This is one of the important things that you must take care of while initiating buy or sell orders into the market. There's another basic concept also of the Fibonacci tool that you must know. Let's learn it with an example. So here we have a chart of the market. The price is making lower highs and lower lows, which simply indicates of market being in a downtrend currently, and therefore we would look out for the areas from which we can go short. The market has made a pullback, and so let's grab the Fibonacci tool from this swing high till this swing low. Price has reached at the 38.2% level, and now it is showing weakness, which can be clearly witnessed by these small-bodied candles formed by the market. When the market makes a reversal from these levels, which are above the 50% level, it indicates that the strength of the sellers has started to get weakened. Likewise, if the price makes a reversal from the retracement levels below the 50% level, it indicates that the strength of sellers is too high. In this example, we can clearly see that the market first went a little below from the 38.2% level, but then it started going above, and then from the 61.8%, it finally made a break and continued going downside. A lot of early sellers would have trapped in this move of the market, and that's why we recommend you to not hurry in getting into a trade, and instead of that you should wait for the market to give out a confirmation. And also, there's one important thing that you should take care of, and that thing is that you must wait for the candle to close before taking any action. Now that we have learned all the basics of the Fibonacci retracement levels, let's move on to the strategy of the Fibonacci retracement. So, in this strategy, we will use the Fib retracement in confluence with the technical tools like support resistance zones, trend lines, supply and demand zones. Let's learn this strategy through an example. So here we have a chart of the market where the price is making higher highs and higher lows. This indicates of market being in an uptrend, and as it is in an uptrend phase, we will look out for the buy areas. As the price has become too high, we cannot buy from this position now, and thus we will have to wait for the price to make a pullback. The market has started making pullback, and that's why we will grab the Fibonacci tool from this swing low to this swing high, and also we will plot the major structure levels like support and resistance zones and supply and demand zones in this chart. Now, as we mentioned earlier, you can plot the Fibonacci tool from any of these swing lows, but you must ensure that you plot it till this swing high. Now, as we are thinking from the perspective of medium-term and long-term investor, we will plot the Fibonacci tool from this swing low till this swing high. The price went below both these levels, which are above the 50%, and now we are left with these three levels only. The market is showing some weakness at this 50% level. The market made a bullish candle after reaching at this 50% level, but we will not go long just by seeing this, and rather we will wait for the price to make some more bullish candles, which will ensure that the buyers are strong enough to lift the price to upside from this point. The price then made bearish candles instead of making bullish ones, and now it has reached to 61.8% level, which is also called golden zone, and also we can see that a major structure level is formed at this level. The buyers tried a lot to push the price above this level several times, but they were unable to do so due to a higher number of sellers. But this time they were successful in doing so. The price went above this level, and now it is coming back. Now let's wait and see how the market reacts to this confluence level. The price has made two bullish candles, and hence we will switch over to lower time frame for confirmation and entry. On the lower time frame, the price is making bullish candles. Now, this is the point from where we will go long. The stop loss will be placed below this 78.6% level, and the target would be placed in the ratio of 3:1 risk to reward ratio. The market gradually started going above, and it reached to our take profit area, which helped us in making out significant profits from the market. This brings us to the end of this video. So, in this video, we shared a highly effective Fibonacci retracement strategy that will help you in making significant profits from the market. But we recommend you to backtest the strategy before using it out for your real-time trading. Now, before we end up this video, if you found our content useful, then make sure to like the video, and don't forget to subscribe to our channel so that you don't miss out any of our upcoming videos.